Throughout the financial crisis, Poland has survived without a single contraction and now looks set to resume significantly faster growth. But that is not to say that Central Europe's largest economy is emerging unbruised. Joining me down the line to share his insights is Societe General's chief economist in Poland. Jaroslaw, with his back against the wall as public debt approached a legal limit of 55% of GDP, the government took the controversial step of revamping the pension system. Now, there has been some discontent regarding sharp falls in fees firms can charge and also concerns about liquidity in the Polish government debt market. In response, some analysts say they are disappointed the pension fund system is being sacrificed on the altar of fiscal concerns. But what are your thoughts?
In terms of the changes in the pension system in Poland, the full impact of the new regulations is not known. It may lower public debt by around 1.2 percentage points of GDP in 2014, but we have some doubts that it will be possible to keep a lower debt to GDP ratio in the coming years without long-term measures. In general, the GDP growth close to 55% will be a risky scenario for Poland's public finances. But we should remember that Poland is under excessive deficit procedure, so the European Commission will be monitoring situation in Polish public finances, and we believe that the new finance minister will decide to implement additional long-term measures, and he will continue policy which will be in line with European Commission recommendations. In general, it's possible that we will see some foreign investors outflow from domestic bond market. The foreign investors may ask for higher liquidity premium on Polish debt market. Also, lower liquidity may impact some indexes, and it's possible that in general, after the changes in the pension system, Polish bond yields will increase. So there is such a risk.
Last month, the National Bank said they would keep rates low until mid-next year. Some analysts have said today's meeting raises no doubts whatsoever, but next year's decisions, though, are becoming increasingly uncertain, considering monetary easing in the Eurozone. Is this in line with your estimations?
Yes, the Council implemented forward guidance, and they suggest that they will keep interest rates unchanged at least until the end of the first half of 2014. We see some possibilities that first interest rate hike will be in the second half of 2014, maybe in Q4 2014. In general, the inflation is under control, so there is no risk that inflation will be above the target next year. But central bank promised that they will provide policy with positive real interest rates. So central bank target is 2.5% in terms of CPI. So when this inflation will be close to 2.0, 2.5%, then we may expect interest rate hikes. We see such probability in the last quarter of the next year.
Growth slowed to only 0.5% in the first quarter of this year, but that appears to have been a trough. Action in both fiscal and monetary policy, combined with the aforementioned signs of a lacklustre revival in the Eurozone, is laying the groundwork for stronger growth in Poland, with estimates for Q3 for 1.9%. But what is your outlook?
GDP growth was quite stable, but very low in the first half of this year. But starting from Q3, we see that real economic activity is slightly better than in previous quarters. It's mainly due to higher investment and also high domestic demand. We had a period of quite low interest rates. Also, inflation was very low. Disposable income of Polish households increased. So we believe that starting from Q3, we will see a kind of rebound in real economy. We expect that contribution of domestic demand will be more visible in the coming quarters, and we think that in next year it's possible that we will see growth close to 3%.
Jaroslaw, there has been a recent divergence within the region, with Hungary, Romania continuing to cut rates and the Czech Bank embarking on currency intervention to help their economy. What impact could all this have on the zloty moving forward? Is there any risk of a currency war in this part?
It's a situation when situation on FX market impacts export growth, and especially it's quite important for Czech Republic. In terms of Poland, export is one of the key driver of Polish growth, but it's not so extremely important for the economy. I think that the Poland will be outside of this quasi-currency war, but it's possible that we will see some market interventions made by Minister of Finance or even Central Bank. In general, I think that zloty could be less volatile than in the previous time, could be quite stable, and of course it's possible that in some period, especially when the Fed will decide to change its monetary policy, we may see higher volatility on Polish zloty. External factors are the most important for Polish zloty, and monetary policy in U.S. is a key factor for Polish currency. So we think that it's possible that we may see in the first quarter next year slightly weaker zloty, and then zloty in a longer term perspective will start to appreciate.
Jaroslaw, great to speak to you. Thank you so much for your insights. Well, viewers, that's all from me for the moment, but make sure you click back to Dukascopy TV for today's press review, looking at those EU banking fines with Elaine Stenson. Goodbye for now.